Hello everyone. Welcome to our channel The Cash Stash TV. Today we are going to talk about one of the most important stock market indices in the world, the S&P 500. If you have ever heard about the stock market and wondered what S&P 500 is, this video is for you. We are going to explain it in an easy and simple way, so let's get started. The S&P 500 is essential for anyone interested in the stock market, whether you are a beginner investor, a student of economics, or simply someone curious about how the financial world works. Knowing this index will allow you to better understand the dynamics of the American market, how economies are measured, and what impact large companies can have on the global economy. We will explore its history, how the companies that comprise it are selected, the methodology behind its calculation, and why it is an indicator so closely followed by investors around the world. So sit back, relax, and join us on this tour to discover everything you need to know about the S&P 500. Here we go. What is S&P 500? The Standard & Poor's 500 Index, also known in Spanish as S&P 500, is one of the most important stock market indices in the United States. This index is considered the most representative of the real situation of the American stock market. It is based on the market capitalization of 500 large companies that own shares listed on the stock exchanges. Capturing approximately 80% of the entire market capitalization of the New York Stock Exchange and the National Association of Securities Dealers Automated Quotations, or their equivalents. The index components and their weighting are determined by S&P Dow Jones. It differs from other U.S. financial market indices, such as the Dow Jones Industrial Average or the NASDAQ Composite, in the diversity of the items it comprises and in its weighting methodology. Unlike the Dow Jones, which only includes 30 companies, the S&P 500 covers a much wider range of sectors, giving it a more comprehensive view of the economy. Furthermore, while the Dow Jones weights its components by stock price, the S&P 500 does so by market capitalization, offering a more accurate measure of the total value of the companies included. It is one of the most widely followed stock indices, and many people consider it the most representative of the US stock market and the trendsetter for the American economy. This index not only reflects the health of the country's largest companies, but also provides a key indication to investors about the overall performance of the market. The National Bureau of Economic Research has classified common stocks as a relevant indicator of business cycles, underscoring the importance of S&P 500 in monitoring and analyzing the economy. History of the S&P 500. The origins of the S&P 500 date back to 1923, when Standard Statistics introduced an index covering 233 companies. This first index was much smaller and less representative of what we know today. Later, in 1926, Standard Statistics expanded its index to include more firms, marking the beginning of what would eventually become the S&P 500. The index as it is known today was formulated in 1957, when it was expanded to include the 500 largest companies in the United States, representing a much broader range of industrial sectors. This expansion allowed the S&P 500 to capture approximately 80% of all market capitalization in the United States, making it a much more complete and accurate indicator of the American financial market. Since its inception in 1957, the S&P 500 has become an essential tool for understanding the stock market and the American economy. This index better expresses the real situation of the stock and bond markets, so it is more sensitive than the Dow Jones Industrial Average and the NASDAQ 100. Over the decades, the S&P 500 has evolved to include a more rigorous selection process and a weighting methodology based on market capitalization, ensuring that it remains an accurate and relevant barometer of the US economy. In addition, the S&P 500 has influenced the creation of numerous financial products, such as index funds and ETFs. which allow individual investors to access a diversified portfolio of stocks with ease. The constant evolution and adaptation of the S&P 500 over time underscores its continued importance and relevance in the financial world. Selection criteria. The companies that make up the S&P 500 are selected by a committee. This procedure is similar to that used by the Dow Jones Industrial Average, but different from other indexes such as the Russell 1000, which are strictly based on rules. In considering a new company's eligibility for the index, the committee analyzes the company's merit using 8 primary criteria. Market capitalization. A company's market capitalization is the total value of its shares in the market. To be eligible for S&P 500, a company must have a market capitalization equal to or greater than $4 billion. This ensures that only companies of significant size, with a considerable impact on the economy, are included in the index. Market capitalization is calculated by multiplying the current share price by the total number of shares outstanding. Liquidity. A company's liquidity refers to how easily and quickly its shares can be bought or sold in the market without affecting their price. To be included in the S&P 500, the ratio of annual dollar amount traded to adjusted market capitalization must be greater than 1. In addition, the monthly trading volume must be at least 250,000 shares in each of the 6 months prior to the evaluation date. This ensures that the company's shares are sufficiently liquid and accessible to investors. Domicile in the United States. To be part of S&P 500, a company must be headquartered in the United States. This means that it must be legally incorporated in the country and have its main operations there. This criterion ensures that the index adequately represents the U.S. economy and its largest companies. Free float. Free float refers to the amount of a company's shares that are available to be bought and sold by the general public. To be eligible for the S&P 500, at least 50% of the company's shares must be publicly available. This excludes shares controlled by insiders or blocks of shares that are not freely traded on the market. Sector classification. The company must be classified in one of the sectors that represent the U.S. economy. This is done to ensure that the index has a diversified representation of the economy. Sectors include technology, healthcare, financials, consumer discretionary, consumer staples, energy, industrials, materials, communication services, utilities, and real estate. Each company is assessed based on its primary industry to ensure that the S&P 500 reflects a broad range of economic activities. Financial viability. To be included in S&P 500, a company must have demonstrated financial viability by reporting profits for the last 4 consecutive quarters. This criterion ensures that only financially sound and profitable companies are included in the index. The committee evaluates the company's financial statements to verify its profitability and economic stability. Length of time listed on the stock exchange. The company must have been publicly traded for a considerable period of time before being considered for S&P 500. This usually involves several years of public trading history. This criterion allows the committee to evaluate the company's consistency and long-term performance in the stock market. Stock exchange. The company's shares must be offered publicly on the NYSE, New York Stock Exchange, NASDAQ, National Association of Securities Dealers Automated Quotations, or their equivalents. This ensures that the company's shares are accessible to a wide range of investors and are traded on well-established, regulated markets. The committee selects companies for the S&P 500 so that they are representative of the industries operating in the U.S. economy. In addition to the criteria mentioned above, the committee may also consider other qualitative factors such as the company's reputation, its long-term stability, and its ability to contribute significantly to the index. Once selected, companies are not guaranteed to remain in the index indefinitely. The committee regularly reviews the companies that make up the index and may remove those that no longer meet the necessary criteria. This ensures that the S&P 500 remains an accurate and up-to-date reflection of the US market and economy. Weighing. The S&P 500 is weighted considering the market capitalization of each company. This means that movements in the stock prices of companies with larger market capitalization have a more significant influence on the value of the index than companies with smaller market capitalization. That is, a large company like Apple or Microsoft will have a greater impact on the index than a smaller company. Standard & Poor's calculates each company's market capitalization using only the number of shares available to be bought or sold by the public, known as the free float. This free float adjusted weighting methodology ensures that the index more closely reflects the market by excluding stocks that are not available for public trading, such as restricted stock or stock held by insiders. Index maintenance. To keep the S&P 500 consistent over time, the index is adjusted to take into account decisions made by corporations that affect market capitalization, such as issuing stock, paying dividends, and restructuring events such as corporate mergers or spinning off portions of companies. Furthermore, to remain a valid indicator of the US stock market, the selection of stocks included in the index is reviewed periodically, with companies added and removed as appropriate. To prevent the index value from changing solely as a result of corporate financial decisions, any decision that affects the market capitalization of the index requires adjusting the divisor of the index. For example, when a company is removed from the index and replaced by another with a different market capitalization, the divisor is adjusted to keep the value of the S&P 500 constant. All divisor adjustments are made after the market closes and after calculating the closing value of S&P 500. These adjustments are essential to maintaining the accuracy and relevance of the S&P 500 as a true reflection of the US stock market. With these adjustments, the index remains a reliable tool for investors and analysts seeking to understand and track the performance of large companies in the United States. ETFs evolution. Since its inception in 1926, the S&P 500's compound annual return, including dividends, has been approximately 9.8% or 6% when adjusting for inflation. The standard deviation of returns over the same period has been 20.81%, indicating significant volatility. Over the years, the index has experienced declines of more than 30% on several occasions, reflecting economic crises and market downturns. However, it has also shown annual increases of up to 70% in recovery periods. In addition, approximately 5% of all trading days on the stock market have seen record highs for the S&P 500. Highlighting its ability to reach new peaks over time and its role as an indicator of growth in the US economy. Importance of S&P 500. The S&P 500 is a reliable barometer of the US economy. When the S&P 500 rises, it is generally interpreted as a sign that big businesses are thriving and therefore the economy is in good shape. This index reflects not only the performance of the companies that make up the index, but also the confidence of investors in the market. In addition, many mutual funds and pension funds use the S&P 500 as a benchmark to measure their own performance, meaning that its performance influences the management of billions of dollars in assets. Also, due to its broad representation of different sectors, the S&P 500 helps analysts and economists evaluate trends and economic cycles, making it a valuable tool for financial decision-making. Investments in S&P 500. One of the most common ways to invest in S&P 500 is through index funds or ETFs, exchange-traded funds. These funds allow investors to buy a stake in all 500 companies in the index at once, offering a diversified and relatively safe way to invest in the stock market. In addition, ETFs are traded on stock exchanges like individual shares, allowing investors to buy and sell them throughout the day, benefiting from liquidity and flexibility. Investing in index funds or ETFs that replicate the S&P 500 has several advantages. First, they typically have lower fees compared to actively managed mutual funds, as they do not require a team of managers to select stocks. They also offer the advantage of instant diversification, reducing the risk associated with investing in individual stocks. For those looking for a long-term investment, the S&P 500 has proven to be a solid choice, with an average annual return of around 9.8%, including dividends. However, as with any investment in the stock market, it is important to keep in mind that there is always a risk of fluctuations and losses. Therefore, it is advisable to do proper research and consider personal financial goals before investing. In short, the S&P 500 is much more than just a number. It is an essential tool for understanding the stock market and the US economy as a whole. Since its inception in 1957, it has provided investors with a clear and efficient way to track the performance of the large companies that drive the economy. This index not only reflects the health of the country's largest corporations, but also acts as a key indicator of economic trends and the business cycle. If you are thinking about investing in the stock market, understanding the S&P 500 is a great first step, as it will allow you to make informed decisions about your investments. Knowing how this index works and its impact on the economy can help you navigate the financial world with greater confidence. Thank you for joining us on Cash Stash TV. Before you go, if you enjoyed the content on this channel, please give us a like and subscribe to Cash Stash TV. Don't forget to hit the bell to receive notifications for future videos. See you in the next one.